Soybean, corn, and wheat prices remain near season highs. Why?
Soybean, corn, and wheat futures prices are near season highs. There's probably three reasons for that. Number one, dry U.S. August weather reduced the corn and soybean crops, so it's tightening up the supply and demand situation. Number two, China continues to buy U.S. soybeans and some corn. They buy sorghum and pork. And I think that the purchases of the soybeans and corn might be more than what the market thinks. So that demand, especially in the beans, is absorbing any farmer selling through harvest. And number three, I think the algorithm machines continue to support the corn and soybean market until it rains in Brazil. The wheat market is pushing higher because of dryness in Russia, U.S. southern plains, and Argentina, which could affect crop production there.
What is the latest world weather?
It is unseasonable for weather to be an important factor here in October. But right now we have dryness in Russia, U.S. southern plains, Brazil, and Argentina. It doesn't look like for the rest of October Russia or U.S. southern plains or Argentina is going to get much rain. And as far as U.S. is concerned, as far as Brazil is concerned, we could see some rains after October 10th over most of the growing areas, which is helpful. The one thing about the drier pattern in the United States is it is allowing harvest to move along. Soybean harvest should be somewhere around 30, maybe 35% done. Corn, maybe 20%. Taking a little bit longer to get going in corn because it's not drying down as much as normal.
When is the next USDA report? Will it impact prices?
The USDA will be out with a crop production and new supply and demand report on Friday, October the 9th. The September 1 stocks report was a shocker, and it rallied futures considerably because they estimated U.S. corn and soybean September 1 stocks lower than expected. Now they'll be having some harvest data to plug in, and we are looking to see if they raise, lower, or keep crop productions for corn and beans unchanged from their September guess. So far, harvest yields have been close to maybe a little bit better than what the USDA said in September. But again, market reaction to these numbers and any changes they make in U.S. or world supply and demand numbers, especially the carryouts, could be volatile.
What is the dominant fundamental impacting gold futures? And what is the price outlook?
The dominant fundamental that has been positively affecting the gold market is the recent weakness in the U.S. dollar. So there is some severe pressure today in the greenback, and of course the gold market is higher, one point as much as $15 higher. Also, the outlook for the dollar, I believe, is to be lower, longer term, as the Fed keeps rates on hold for quite a few years, probably out to 2023. So the trend on the gold market still appears to be higher, I believe, in the short run, and also higher in the longer run.
Federal Reserve Chair Jerome Powell will speak tomorrow at 9:30 Central Time to the National Association for Business Economics. What will he likely say?
So Fed Chair Powell tomorrow will probably talk about the need for more fiscal stimulus. I think he will be somewhat upbeat on the economy, although most likely he will indicate that any recovery that we do see will likely to be protracted and not very much to the upside in the near term. Also, I believe that he will say that if necessary, that the Fed could add more stimulus in one form or another. At least I think he will hint at that direction. But I think the main focus will be the need for more fiscal stimulus at Powell's comments tomorrow.
What is the best way to trade the interest rate futures market?
Well, the best way to be trading the interest rate futures markets is to be spread. I believe traders should be long the front end of the curve and short the long end. Now, this has worked since August. In fact, most of August, this trade worked very well. Was a sideways mover in September, and now starting to work again very well in October. The reason that the front end will hold up steady is all of the stimulus that we are seeing from the Fed and the Fed's indication that they will keep rates unchanged, or at least will not raise rates until 2023. But the long end is another story. There could be some inflationary pressures due to all of the spending globally, including here in the U.S., and the tolerance for higher inflation from the Fed. So the long end is likely to come under some pressure, while the short end futures will remain very stable. So once again, I prefer to be long front end futures and short the long end, especially the 30-year Treasury bond futures.